Hello and welcome to this week's US Stock Market Report. I'm Gillham, Chief Analyst at Wealth Within. This week I'll be discussing Warren Buffett's approach to investing, and then I'll dive into the Dow Jones. Now before we jump into the report, I'd just like to mention if you have any thoughts on investing, please comment below and subscribe to our channel to keep up to date with our new content. So let's get into this week's report. Warren Buffett, also known as the Oracle from Omaha, is arguably the greatest investor of all time. Buffett is the CEO and largest shareholder of Berkshire Hathaway and has amassed an astonishing $82.9 billion in personal wealth, making him the third wealthiest person in the world. So how did he do it? Well, one thing my mentor said to me when I was young was to find somebody who is successful and in a position where you want to be and essentially copy them. Warren Buffett has had incredible success sticking to his principles in the stock market, and yes, he had a mentor in his early days. To me, there's no surprise as to why his philosophy to investing is so popular. So how does Warren Buffett invest, and why is he so successful at it? Well, what follows are 8 investment tips or insights from Warren Buffett, and I'll break them up into 3 parts. And so this week I'll be discussing the first few and the remaining over the next 2 weeks. Now the first one is long-term value investing. The Warren Buffett strategy is a long-term value investing approach passed down from his mentor Benjamin Graham and his school of value. Benjamin Graham taught the long-term value investing strategy of purchasing stock at a price below their intrinsic value, then holding them until their price reflects the real value of the company. According to Buffett, the secret to getting a better return on investment is to buy a stock and forget about it. He believes in having a buy and hold mentality and insists on holding stocks for decades. He is quoted as saying, if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. Further, he states that if you constantly buy and sell stocks, it will take away a significant percentage of your returns in the form of trading commissions and taxes. So it is better to buy a great stock and hold them for a long time. Now, whilst I agree with Buffett on most things, as a trader I have some slightly different views on this, as modern day technology has made brokerage very cheap and pretty much insignificant in the big scheme of things. Further, the ease and speed of transactions that can be achieved in today's market means that holding stocks for long periods means you cannot compound your returns like you can with buying low and selling high. Even after factoring in capital gains taxes, I found that there is great value to be had in actively managing your portfolio rather than having a passive buy and hold approach. Remember, Buffett has been investing for over 76 years, and times have changed. It also takes time to build a fortune, and even Buffett did not amass 99% of his wealth until after his 50th birthday. Now, I totally agree with him in that you should stick to investing in good stocks. I also agree with Buffett when he talks about not letting fear and greed change your investing criteria and values. This means you need to avoid being overwhelmed by outside forces that affect your emotions. Most importantly, never sell into panic. All great pieces of advice, which sadly most investors or traders do not adhere to. Diversification is the next area. And he says diversification is not always a good idea. Now, many good investors stress the importance of diversification. In fact, it's an industry mantra. But Warren Buffett tends to disagree with the idea, and so do I. Buffett says that diversification is for people who do not know much about investing. And I have to agree with that. An experienced investor should choose stocks on a long-term basis and should have faith on his or her investments. Now, investors diversify their portfolios because they are afraid that any one stock might sink their entire portfolio. So by diversifying, they attempt to reduce the volatility of their portfolio. But at the same time, they also reduce their focus on individual investments. Now, what I've found in my research is that this focus on diversification has the effect of reducing portfolio returns. So here, Buffett and I totally agree. Buffett waits for opportunities to buy good stocks, and when those opportunities come his way, he takes full advantage. According to Buffett, when it's raining gold, put out the bucket, not the thimble, and I totally agree. Now that brings us to the end of the first part, and next week I'll continue with more of Buffett's insights. So what do we expect in the market? Alrighty, on your screen right now, I've got a weekly chart of the Dow Jones. Now, for you who've been watching these recordings for the last few weeks, you'll know that I've been expecting the Dow to come down to around about that 22,320 point mark that I've been chatting about for the last few weeks. Now, interestingly, we did have a rise up through to the week ending the 11th of May, getting up to that 24,868. Now that was a little bit surprising to me, but I remember talking about that, saying I was expecting the market to fall away a little bit further. But this last week, the week ending the 18th of May, we saw the Dow head up to 24,994 and turn around and come back down to close at 24,715. So what you're seeing here is the open gapped up, and then it closed lower for the week. So what we'd be expecting is a move down again. So it'd be interesting to see if the Dow can come down a little bit further, because whilst I don't think it's super bearish at the moment, I'm going to add another level to my little chart here. And you can see here that it's hit the 25% retracement of the range that I've got marked there. So what I've done is I've scrolled too far. I've used the range from the low back in August 2015 through to the high in January 2018. I'll slipped a little bit off my point there. So that's what I've got here. So we still can accept it falling that 25%, and it has fallen into that. So because the markets move in time and in price, and we can predict time and we can predict price. We just need to make sure that we're using the right context in terms of what cycles, whether it's short, medium or long-term cycles. And right now, I still do think it's probably got more probability coming down to that 38.2%, because I think the market is a little bit overheated. I'm not too stressed about it getting into another GFC type situation. I know there's a lot of talk about that at this point in time, but I think we might get a bit more of a pullback. It may happen quite quickly over a matter of a couple of weeks, but right now the Dow is slightly looking a bit more bearish than it is bullish. So let's get into this week's report. I actually wanted to get into the banks, the US banks, and on your screen at the moment I've pulled up, I'm going to do about 4 of them. So right now I've got Bank of America on the screen, and looking at the left hand side of the screen you can see the all-time, I'll bring it up on a monthly chart, it'll be a bit easy for you to see here. That is the history of the data that I have back to 1995. Obviously Bank of America has been around a lot longer. Its high was $55 back there in 2006, and you can see it's way off its all-time high. Now, banking was hit very, very severely during the GFC, as you very well know, with some banks closing off. So at this point in time, just putting a little bit of some tools, my price tools on it, you can see here it's now above this 50% level, which is the halfway mark between that high that it had in 2006 and that low back in February 2009. Given it's now broken through this, I think there's some lot more upside on the Bank of America with that next level at 34.95 and further up to 41. I don't think there's any reason why it couldn't get through those two levels. It's looking quite a stable run. It's not super volatile at this point in time, and it's a nice steady trend. So I do actually like this stock, and I think it's looking okay. So let's go on to JP Morgan Chase here and having a look at that. The stock ticket code here is J for John, P for Peter, M for Mary. Having a look at that, it's a completely different ball game here, isn't it? Because obviously we're seeing this huge downward move all the way through down to this low in 2009. So it was already falling from here, March 2000 here. So the GFC was around about, sort of not here, where is it? There's somewhere in around here was sort of the high of the GFC. So it had been fallen already. So often the market with the big stocks, they all start falling away before we see the rest of the market fall away. So what happens is a lot of the big stocks that people get nervous of, they start down selling those and going into other stocks that they think are better value. So often we will see good stocks fall away a little bit more. But since that low in March 2009, this thing's powered on. Doing very, very, very well. Now closing last week at $111.13. At this point in time, I don't really see, I think it's moving up. It is due for a bit of a pullback. I think we might see a bit of a retracement because you can see the angle of that trend. And I know you've heard me talk a bit about it before. The angles of trend means what's going on. At this point in time, it's quite steep if you're looking at this move from this low here back in August 2015. That's quite steep. To me, I think it might do a bit of a retracement. So would I be getting into this? No, I'd be looking at the prior company that we're talking about. So when we're looking back at Bank of America, that's one I'll be looking at more over JPM, which is on your screen right now. Let's look at Citi. Citi's a great stock to own as well on the New York Stock Exchange. You can see there on the left again, on the monthly chart, a little bit more volatile, this stock, and you can see how it is a bit more volatile. Again, it's not above its all-time high back from February 2007. It did fall very, very heavily into the GFC. It has moved up since then. So right now, we're seeing around May 2018, the current monthly bar, we're looking at $54.17 in a nice uptrend. I think there's more upside on this, and I do think it will start break through that $61 level and keep going up. Let's look at the last one. Goldman Sachs is the last one I want to have a bit of a look at. And again, like JPM, it is above its all-time high back here from October 2007. That's its all-time high prior to the GFC. A little bit more different. As I said, it went down into the low end of the GFC, into November 2008. And had a big run up here. It took a little while to get going, but it's broken through its all-time into a new all-time high of $275.31. Now it's having a little bit of a breather, so I think this might go on a little bit more, but there's no reason why we can't, when it finds some support, and it probably will find support around that sort of $200 to $210 level and start to move up. So I think there might be one more move up before we see another more protracted retracement like we're seeing in what we saw in the GFC, or like we saw here from October 2009 down to that low here back in, 2011. So we might see a 6 to 12 month fall away, but right now I think there's a bit more upside potential on this stock. So that's my take on the banks, all these banks in the US at the moment. So I hope you've enjoyed the report. If you want me to look at a stock that you're interested in, please comment below, ask me a question, say, hey Dale, can you have a look at this stock? And I'll have a good look at it for you and put it on the recording. So good luck and good trading. What are your thoughts? If you've got any questions, please comment below. Go and listen to our Talking Wealth podcast. They're available on SoundCloud and on our website. Now they're jam-packed with valuable information which will help you elevate your trading. Now if you're serious about learning to trade the share market and you'd like more information about our courses, please click the link in the video description below. Thank you very much for watching this video. If you've liked the video, remember to subscribe to keep up to date. I'm Dale Gillham, the Chief Analyst here at Wealth Within. Goodbye, good luck and good trading.